All right, so I'm going to teach you a little bit about intraday profiles and daily range, and we're going to be using this idea here. So if you look in this area here, that's my fair value gap. And you can see we traded down into it here. And today, one more time, we traded down into it, left these relative equal lows in place, and then started to move higher. I took everybody's attention to previous day's high right here. So we're expecting higher prices after this shift in intraday volatility. What did I do, and how do I go about abandoning a specific bias? How do I change gears if it is applicable? Sometimes it's not applicable to reverse. It just means move to the sidelines and just say, I'm not going to do anything. And what are the characteristics that would lead to a bias that is changed? And how do you use that logic going forward? And how to navigate the New York lunch hour. All right, so notice that we had this low here taken with this run. Then this low was taken with this run, and this low was taken with that run. So notice what we were seeing. We're seeing multiple lows get taken, and then the market reverses, while offering really no high probability shorting opportunity. The 40-70 level never got tagged, liquidity left in place. Previous day's high, which is here, that high was not traded to. And then we have a fair value gap over here. So you have two premium arrays that may be a draw on liquidity. It takes us up in here and maybe even run above these relative equal highs. All right, on the 15-minute time frame, you can see how we just kept going lower than the previous lows, and then finally we had a run higher. So we had a short-term shift in market structure relative to the 15-minute time frame. Remember, that's our bellwether chart. So it runs higher, creates a fair value gap in here, and trades down into it here. What is narrative? Narrative is the understanding of what price should do, why, and what things will it encounter to prove that the narrative that you are assuming is in place is in fact underway. I was looking for 40-70 today to see if it can get down outside the range of that daily fair value gap. And we failed to do so. And then the market shifted higher. Now, the whole time I'm looking at the market, it's not giving me any kind of short. I'm not comfortable taking any kind of short. And all of a sudden the market does this. Okay, no panic. So we had created a fair value gap here on the 15-minute time frame. So right away, that is your area to watch and see if price supports a run. If it digs into that and starts to repel higher and we take out this short-term high, that is enough to set up a stage for the afternoon trend. Okay, that afternoon session move or setup or price swing, that's what we're looking for now. Because the market failed to go to an objective we were looking for, it was respecting that daily fair value gap. Here, it took out that short-term high. So now we have an absolute market structure shift. Bullish with this swing high, and the market comes back down in here and rebalances this fair value gap. So I'm not looking at support and resistance. I'm looking at the fact that we went through this short-term high, created an imbalance, and then we traded down into that. And then when we get into this area here, I'm interested in looking at intermarket relationships. I want to study real accumulation and distribution. We're going to go into a lower time frame, 5-minute chart. All right, so here's the 5-minute chart. It digs down into that 15-minute time frame, fair value gap here, and then rallies higher. Then it starts to trail off and goes down into this imbalance right here. And I want to talk a little bit about New York lunch. Okay, I gave you rules of engagement when you're trading the afternoon session. And primarily what I gave you for the model was a morning session idea. Now, if the market starts to go higher, okay, in other words, if we've been in a bullish market structure and order flow is bullish, that means everything's going in one direction. The market's obviously going higher on all time frames. Then that's an easy trading scenario. But we're inside that little trading range area on the daily chart. Last few days, or a week or so, it's just been hanging around that small little range. So you have to know what you're doing or you're going to get caught up. So initially I wanted that 40-70 level. We failed to go outside the shaded area here. That's that daily fair value gap. Notice that these lows here, this is lower than that one. Why is that important? Why am I drawing a distinction between those two? Well, if you go and you add your NASDAQ chart overlay, you'll see that this is a divergence. So even the S&P was relatively stronger than that of the NASDAQ. NASDAQ made a lower low here. This is the opening price at midnight. Now I teach if we're bullish, we want to be buying at or close to the opening price. Okay. Now here's one of those advanced ICT things. Okay. If you know that the market is likely to go down to go up, then you can wait for price to give you this type of setup right here, where it goes down, shift in market structure, come back down into a 15-minute time frame fair value gap. This is intraday or day trading. It is not the model I gave you where it is a scalp. Essentially, that's what that is. The model I've provided for you for this YouTube channel is a scalping model. But if you're going to day trade daily range, you're going to be using the 15 and 5 minute chart, and there it is. Now you can use that model that I gave you for entries and scalping. You can use that as your entry criteria, but with the logic and narrative that you're going to be trading the daily range. So if we're bullish, we're going to be looking for the opening price at midnight is going to drop down, create the low of the day. It's forming it at 9:10 New York local time. It rallies up, shift in market structure, so it doesn't give me my objective. And then the market rallies up. Okay, what I was looking for, it didn't reach it, and it didn't give me a setup. The S&T divergence here in the higher low versus the lower low in NASDAQ comparably. And then we have that shift in market structure. We trade back down into the 15-minute fair value gap here, and then we rally once more. Once I saw that, then I'm good to go. I'm waiting for the afternoon setup. But now watch what's happening. The market rallies up, falls short of 41.40, and then it drops down into the fair value gap, starts to rally, but look what it does. It leaves these smooth relative equal highs. And then does what? Drops once more below that short-term low. Now, think about what I've given you in your notes as it relates to trading the PM or afternoon session. If you're bullish, generally what will happen is the market has ran higher in the morning, then it consolidates into the lunch hour. Then after the lunch hour, it'll drop down and sweep the sell stops or below some short-term low or the lows made in lunch. Okay? Now watch what this does here. It creates a low ahead of the lunch hour at noon. Then it drops down into the fair value gap. Is that not doing what I gave you in terms of the rules of what liquidity is doing in the afternoon, post New York lunch when we're bullish? Yes. What's different? It's not consolidating. See that? Is this a consolidation? No, it's a retracement. So if you can identify an area where it's likely to retrace, why am I measuring from here to get this versus this here to here? Well, you have to ring in what I'm trying to do. I'm trading the daily range. I'm trying to get the majority or the lion's portion of the daily range. So because I'm doing that, I'm factoring in that midnight opening price. So we've went above it here and once more. So I'm not expecting it to go back down below here again. So to refer to this low now, again, is pointless. I'm going to use this one here for market structure. So market structure swing low here to swing high, that's my dealing range. But anyway, it's taking out that short-term low on a retracement. But if it was consolidating into lunch, I would look for the swing lows during the lunch hour and then wait for it to drop down, sweep them like it's doing here, and then rally. But because this is a retracement going into lunch, that to me, it signals that they're going to work through lunch. What does that mean? Years ago, when we were on the floor only, open outcry, sometimes the floor traders would know that the market was in a hurry. It's a fast market. So they're not going off the floor. They're going to stay busy on the floor and they're going to be trading. So I learned this from an actual floor trader. So I'm not making it up. I'm not just giving you some kind of garbage made up or some contrived nonsense. It's based on what they used to do. And that same mentality has been transferred into electronic trading. So the algorithm does that same thing here. During the lunch hour, if it's a fast market, it's retracing back down into a random fair value gap. It creates a short-term low, and then it runs the only short-term low that's there from here to here. This is too narrow. We don't want that. It's already moved too much. And it's going into that hour ahead of lunchtime, noon to 1, New York local time. So I want to see it retrace back down into a discount. How is that done? From that low to high. So the algorithm reprices to a discount once it gets to here. Then it does what? Creates that short-term low, rallies a little bit, leaves smooth highs in here. So what is that? They think that is resistance. So anyone that's short, they trail their stop loss here, and then it drops one more time right below that short-term low. What's below that short-term low? I have already told you here, sell stops. So I'm thinking, like smart money, this is going to go higher in the afternoon. So let's talk a little bit about narrative. When the market shifted here bullishly, and it came back down into that 50-minute time frame fair value gap, and then rallied, this right here told me that they want to set this up for a bullish run in the afternoon. Why? Go back to that daily chart. Remember, we were inside this shaded area here. That's the fair value gap. So it dips down into that lower end of that fair value gap, and then rallies, trades back down into the 15-minute time frame fair value gap, which is what that is here. And then it rallies. Now, right away in my mind, this tells me that the algorithm is priming itself for an afternoon run to potentially previous day's high, which is this level up here. Okay. So from here, right when it crossed over here, I'm thinking, okay, it could potentially be running previous day's high. I don't know it yet. Then when it drops down into here and then rallies from that, then I know it. Now that's narrative. Do we see displacement? Yeah, we do. Is that an energetic price run? Oh yeah, it is. Then that low to that high, I want to get that measurement for premium to discount. And what do I want to wait for? A discount. Now, what happens if it would have went here and rallied? Okay, well, I would have missed the move. But I'm looking for sell side liquidity. I want to see a stop run, because what that's doing and how this fits into the narrative is, if I'm thinking that this move here to here and then retracing down is setting up an afternoon run to potentially this level here by the close of the day, I want to be like smart money and do what? Buy sell stops. That is buying sell side liquidity. So the premium array is up here, the discount array is here. Doesn't it make sense for you to anticipate the move originating basically from here, running above here, taking a partial, and seeing if it can gravitate towards that high? Yes. So I mentioned I'll go into the SMT diversions in here, so let's do that now. All right, so I'm adding the little compare tab and make sure it's highlighted to low, because what we're doing is we're comparing and contrasting the lows inside of a fair value gap after a retracement into a discount when we're expecting to potentially trade up in here. This low versus this low. You see that lower low? Is that seen here? Low, higher low. We're comparing lows. So when we're bullish, we're plotting this line down here as a compare and contrast tool. It's my way of measuring real accumulation distribution. So if we know that this area down here is a discount, and we know this is an imbalance, fair value gap, it trades down into a pool of liquidity. Below that low is sell stops, and I want to buy sell stops inside the fair value gap during a classic buy day, which is open at midnight, trade down, create the low of the day, rally, and then creates an optimal trade entry or fair value gap, or you're going to buy the short-term low during SMT diversions. Okay, so there's real accumulation here between the NASDAQ and S&P. So this tells me that the NASDAQ is failing to go lower, so it's under accumulation, and this is just a stop hunt below that short-term low. See that? Now, some of you are like, this is really complicated, ICT. I really like the optimal trade entry, and these fair value gaps are all over the place. How do I know which one is the one I want to use? Okay, check this out. A lot of you know how to use optimal trade entry. You'll use the low here to the high, pull your fib up, 62 to 79% retracement level. If it goes down to that, then you'll buy it. Okay, that's one pattern. But now watch what else there is. This is turtle soup. You have a low, lower low, buy the low that's being violated with optimal trade entry. See that? Or you can just do this. Low, high, find the fair value gap below 50% level, which is a discount. Soon as it trades to the top level of it, hit it there, buy it there, stop below the lower low or level here. There's your pattern. Or you can do this. You can wait for it to trade down into this like that, and then find the swing high prior to it trading into the fair value gap and put a buy stop there as your entry. And whatever the lowest low is, after it hits that, that's where your stop loss would be, just right below that. And you can be buying strength. That's not, in my opinion, the preferred entry strategy, but I'll just give you a bunch of them. But it's using what? Bias that has been corrected and calibrated based on what the market has done here at key times. Okay, so at 9:30, the market does what? It brings us that volatility we look for. So it shifts higher after we have another SMT divergence here, but we have that shift higher. It's showing us real accumulation in the S&P. It rallies. I don't want to chase that. I wait for it to come back down into a 15-minute time frame, fair value gap, which it does. Once it comes into the 15-minute time frame here, then it rallies like this. Then I'm comfortable knowing what I'm looking for. What is that? Dealing range low, dealing range high, fib across it, 50% below that. Here's a fair value gap, trade down into it. I want to buy sell stops. That's just me. I want to do it because it really fortifies the setup. It allows me to get in where the smart money will be buying. That little movement here, I'm buying that very candle. I didn't buy the next candle. I didn't buy the candle before that. I bought below that price. SMT diversions here. You see that? SMT diversions here. Lower low, higher low. Here we have the lower low in NASDAQ, higher low in S&P. That sets the stage for that run higher.